The market just got absolutely shattered. After President Trump threatened to slap an additional 100% tariff on Chinese goods, the calm we've seen for months was completely wiped out. On Friday, the S&P 500 plunged 2.7%, its worst single day drop since April. The Dow dropped nearly 900 points and the tech-heavy Nasdaq fell a staggering 3.6%. A wave of real panic is starting to ripple through the financial world. But here's the thing, while most people are debating whether to buy the dip, they are missing the real story here. They're asking the wrong question entirely. This isn't just another bumpy day in the market, this is the first domino. In this video, I'm going to break down the 3 critical signs that show this isn't a temporary dip but the beginning of a new bear market, and explain the one thing that you absolutely need to know to prepare for this new economic reality. So why is this plunge a much bigger deal than just a bad day you can ignore? To get it, we have to zoom out and look at the bigger picture. This sell-off didn't happen in a vacuum, it happened when the market was stretched to its absolute limit, priced for nothing but pure perfection. For months, investors have been piling into stocks, especially those high-flying tech stocks, pushing the valuations to dizzying heights. There was this quiet assumption baked into every single stock price that inflation would keep cooling off, the economy would stay strong, the global trade would be totally stable. It was an assumption built on hope, not reality. And the hope just collided with a brick wall. The threat of a full-blown trade war again, with those massive additional tariffs, isn't just a political headline, it's a potential wrecking ball aimed at the entire global economic system. What we're watching is not a temporary spat, it's the next phase in a much larger multi-decade shift. The era of hyperglobalization, that 40-year period of ever cheaper goods from across the world that has powered our economy, is fundamentally breaking down. This isn't just about one president or one policy, it's a geopolitical realignment that is only just getting started. Think about it, the market has been addicted to cheap labor, cheap parts and frictionless supply chains. That addiction created massive corporate profits and sent stock prices soaring. Now the withdrawal is beginning. The world is splitting into economic blocks and the cost of doing business is about to go up permanently. What happened on Friday wasn't a disease, it was the first major symptom. It's the moment the market was forced to face a reality it had been desperately trying to ignore, that this is just an opening act. So let's break this down. The first sign, the catalyst for this whole mess, is the tariff threat itself. And you've got to understand what a tariff actually is, because it's not what most people think. Politicians love to talk about tariffs like there's some bill that China pays. They are not. A tariff is just a tax, and that tax is paid by the American company that imports the goods. So when a company like Apple imports an iPhone component or Target imports furniture, they are the ones who pay the tax at the border. Once that happens, the company has 2 choices. Both are bad for the stock market. First, they can just eat the cost. Imagine a company with a 10% profit margin. A sudden 100% tariff on its components could instantly wipe out its entire profit margin. And then some. If profits vanish, the reason for the stock's high price evaporates, the stock falls. The second choice, well, they pass the cost on to you, the consumer. The price of that iPhone, that couch, that power tool, it all goes up. This creates a different but just as damaging problem: inflation. When prices for everything rise, people can't afford to buy as much, demand weakens, sales fall, and corporate revenue drops. And again, the stock falls. And this isn't some theory, let's use an analogy. Imagine for your own bakery, for years you've bought flour from a supplier at a great price, suddenly the government slaps a 100% tax on that flour, your main ingredient just doubled in price overnight. What do you do? If you keep your bread at the same price, you would start losing money on every loaf, but if you double the price of your bread, your customers might just stop coming. Either way, your business is in serious trouble. Now multiply that baker's dilemma by tens of thousands. That's what a broad tariff does to an entire economy. It's a direct squeeze on corporate profits on one side and a squeeze on consumer demands on the other. Historically, this is a classic recipe for a recession, and a recession is almost always joined at the hip with a bear market, a decline of 20% or more from recent highs. This tariff threat is the match that was just thrown into a very, very dry economic forest. And the fundamental story is grim, but it actually gets worse when you look at what the market itself is telling us. That brings us to the second critical sign. The charts are screaming a warning. In the financial world, traders and big institutions watch key technical indicators to gauge the market's underlying health. One of the most important is the 200-day moving average. Think of it as the ultimate line in the sand between a bull market and a bear market. It's the average closing price of the S&P 500 over the last 200 trading days. On a chart, it's a long smooth line. When the market is trading above that line, it means the long-term trend is positive. The bulls are in control. But when the price breaks and falls below it, that's a major red flag. It's a signal that the long-term trend is reversing. With Friday's brutal sell-off, the S&P 500 didn't just dip, it sliced straight through that critical support levels. For analysts who watch these signals, this is a 5-alarm fire. It shows the selling pressure was so intense, it just overwhelmed the market's long-term upward momentum. But the real danger is what comes next. What analysts across Wall Street are now watching for with bated breath is a pattern ominously known as the death cross. It sounds dramatic because it is. A death cross happens when the market's short-term momentum, the 50-day moving average, crosses below the long-term 200-day moving average. It's the technical confirmation that the trend has officially shifted from up to down. It's a sign that the weakness isn't a fluke, it's becoming locked in, and this isn't some obscure pattern. The death cross has chillingly accurate track record. It showed up before the 2008 financial crisis, which saw the S&P 500 fall over 50%. It showed up before the dot-com bust in the 2000s, which kicked off a bear market that lasted for years. While the death cross hasn't officially formed yet, Friday's plunge has put these two lines on a collision course. The market has fired its warning shot. The technical picture has shifted from a healthy uptrend to one that is now broken and threatening to roll over into a real sustained downturn. When the fundamentals of tariffs align with bearish technicals like this, ignoring the signal is just reckless. So we've got a fundamental catalyst with tariffs and we've got a major technical breakdown on the charts. But the third and maybe most dangerous sign is the environment where this is all happening. The market was already a bubble just waiting for a pin. For the better part of the year, people have been warning that stock prices had become completely detached from reality. One of the best ways to measure this is with the Shiller price to earnings ratio, or CAP-E ratio. Unlike a normal PE ratio that just looks at 1 year of earnings, the Shiller PE compares stock prices to the average earnings over the last 10 years. Adjusted for inflation, it gives you a much better sense of whether the market is truly expensive compared to history. Especially the Shiller PE has been hovering in the mid to high 30s. To put that into perspective, historical average is around 17. We're in a territory that has preceded some of the most devastating crashes in history. While it's not quite at the dot-com bubble's peak insanity, it's significantly higher than it was right before the 2008 crash. This is exactly what analysts mean when they say the market was priced for perfection. Investors' expectations were so high, valuations were so stretched that there was zero room for anything to go wrong. People were paying prices that assumed flawless execution, endless growth, and a stable global economy forever. When you're walking on a tightrope, even a tiny gust of wind can be catastrophic. The market was on a valuation tightrope. News about tariffs and a renewed trade war wasn't a tiny gust of wind, it was a hurricane. This is the key. The tariff threat is the pin, but the dangerously overinflated market is the balloon. When a shock hits a fairly valued market, it might cause a 10% correction that bounces right back, but when that same shock hits a wildly overvalued market, it can trigger a total collapse of confidence. Investors who were willing to pay any price for a stock suddenly look at each other and ask, what were we thinking? The panic to get out becomes a stamp, and that is how a 5% drop turns into a 20, 30, or even a 40% bear market. All this sounds pretty dire, and it is. Panic is never a strategy. The absolute worst thing you can do right now is sell everything in a frenzy, or on the other hand blindly buy the dip, thinking this is 2021 all over again. You have to understand that the rules of the game have fundamentally changed. The decade of easy money where you could throw dart at a tech stock and make profit is over. In a bear market, especially one driven by the deglobalization, the market becomes ruthlessly selective. So how should you think about this new reality? Well, this isn't financial advice. It's a framework for survival. It's time to stop thinking like a speculator and start thinking like a business owner. When things get tough, what kind of business actually survives and even thrive? First up is companies with real profits and strong cash flow. The era of rewarding growth at all costs is dead. In a world where money isn't free, cash is king. You want businesses that generate more cash than they burn, day in and day out. Those story stocks with no profits are going to get devastated. Second, look for companies with low debt. When the recession hits and interest rates are high, debt is an anchor that can pull a company right under. Businesses with fortress-like balance sheets, tons of cash and little debt have the flexibility to ride out the storm, buy their weakened competitors and come out stronger. And third is find businesses with pricing power. That's a company's ability to raise its prices without losing its customers. It's the ultimate defense against inflation and tariffs. Who has it? Well, companies selling stuff people can't live without, or companies with incredibly strong brands that command loyalty no matter the price. Finally, think about the companies with resilient domestic focused supply chains. Businesses that rely heavily on a single country, especially one that's now in the crosshair of a trade war, are carrying a ton of risk people aren't appreciating. Companies that make and sell their products closer to home will have a huge advantage in a world that's breaking apart. This is the mindset shift. Stop chasing hype, start demanding quality, resilience and profitability. That's the framework that will not only help protect your capital in the coming storm, but also help you spot the opportunities that will rise from the wreckage. This is a huge topic and it's changing by the day. If you're getting value from this kind of no-nonsense breakdown, do me a huge favor and hit that like button. It tells YouTube this analysis is important and helps the channel reach more people who need to hear this. And I want to hear from you. Drop a comment below. What's one thing that worries you most about the market? Is it the tariffs, valuations, inflation? Let's talk about it. But let's bring this all together. A major geopolitical shock has slammed into a dangerously overvalued market, shattering key technical support levels along the way. This doesn't look like just a dip. We're seeing the fundamental catalyst, the technical breakdown, and the pre-existing bubble conditions all line up. It is highly likely we're in the opening stage of a new and difficult bear market. The coming months will almost certainly be volatile and full of headlines designed to cause anxiety. But remember, times of crisis are also time of revaluation and opportunity. The investors who come out ahead won't be the ones who bury their heads in the sand or panic sell at the bottom. They'll be the ones who recognize the world has changed and adapt their strategy to the new reality. Focus on quality, focus on resilience, and above all, stay informed. If you want to keep up with how I'm navigating this downturn, make sure you're subscribed with the notification bell on. I'll be dropping more videos, and thanks for watching, and I'll see you guys in the next video.